what actually goes into finding the next property investment hotspot? Hi, I'm Sam Powell.
And I'm Djolic Krause, and I'm the co-host of Property Pals Australia, as well as Sam being the co-host of Property Pals Australia. And in this podcast episode, we talk to Matt Djolic, I hope I'm pronouncing it correctly, who is the co-founder and director at HTAG Analytics, which is one of Australia's leading property data businesses. What do we talk about in this pod, Sam?
Yeah, we go into a lot of detail, and it's highly valuable to go through all the way to the end. This is going to be a two-part series, but in part one, we talk about Matt himself and what inspired him to co-found HTAG Analytics along with Alex, and we also jumped into the business itself and its performance over the last decade in Matt and Alex analysing property investment markets around Australia to help people with those increased growth opportunities. Because as we know, Jaryd, there's a big opportunity cost in getting it wrong, right?
Huge opportunity cost in getting it wrong. We also talk about the long-term investing and short-term investing in property, and is it becoming more viable now with data such as what HTAGs is providing to work out to trade property for the short term and how long for? So we talk about what's the average, if we find a hotspot, what's the average time period that is worth holding onto a hotspot before it sort of flattens out, the growth curve flattens out, and then what your opportunity cost would be if you didn't move into another asset. Now, there's so much value in this podcast episode. Obviously, it's part one. Make sure you listen to part two, because in part two, we do talk about different hotspots, how they are built and made, and what goes into those. We talk about the advancement of property investing with, data, and then with buyer's agents, what the landscape is going to look like investing in property in the future. And there's so much value there. So stay tuned and enjoy this pod. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Matt, welcome to the podcast.
Thank you for inviting me, boys.
It's a pleasure to have you. In case you, I guess, don't follow everything we do, Matt was just got back from Europe, and we were about to do a podcast with him, and I think the background was pretty much the same as your shirt you're wearing at the moment.
I was laughing my head off. After that, I'm thinking, who said it? Was it you, Sam? We go, it's a bit black over there, or dark over there, or something like that. Yeah.
It was an awesome commitment. Waking up super early, trying to get sneak away from the family before they wake up. But now we've got capacity to chat. So yeah, thanks for coming on.
It's nice and sunny over here, so we're not going to have any issues with the background.
Yeah.
How are you, boys?
Yeah, good, thank you. So we Sam let me know about you a couple months ago, and just basically fanboyed on HTAG, and I wanted to ask you what is. Let's just give a quick rundown of what is HTAG Analytics, and why did you start?
Yeah.
What's the inspiration for this?
Yeah, so it's essentially a data providing platform, but it's evolved into something more, in a sense that it's not only a place where you actually come and obtain the data, but it's I would say pretty much an on-demand course, in a sense that we also provide or teach a methodology on how to actually superimpose 20, 30 or 40 metrics to arrive at a particular conclusion. The reason why we started was I met my co-founder, Alex, about 6 or 7 years ago, and we're both nerds, and he actually gave me a book on big data. And I started reading, and I realized I read a passage or a chapter where UK banks use big data regarding traffic lights. Traffic lights data. How many I guess cars stop at a traffic light, how many cars you have in a traffic, etc., etc. And they use that data to actually make decisions with respect to lending. And I'm like, interesting, because it's a large volume of data, like large data set, so you can actually extrapolate, I guess, conclusions from that. And I was thinking, okay, why don't we do that with property? Because we were investing in property at the time. I was going to every possible event that's out there. I was reading every possible book, doing my spreadsheets, trying to organize everything. And I remember back then it used to be, is it my or your investment property magazine? What was the title? Your, that's it.
Yep.
And you know how at the back they had, data for a particular month, like vacancy rates and all of that. And then I was thinking, okay, but that's like a snapshot in a point in time. I don't see trends, Anyway, one thing led to another. I remember back then I used to speak to some buyers agents. I used to go to their seminars. You know how they used to, let's say, promote their service by having a seminar essentially.
Yep.
And I remember speaking, I can't remember what the name of the company was. And I said, guys, why aren't you looking at Southwest Sydney? Back then I think they were buying in Gladstone or Mackay. And they're like, no, we're not interested. There's nothing happening there, And I'm like, okay. And I went to the council website, and I don't know if you guys can recall, Southwest and Northwest Sydney used to be branded as growth corridors because of the Sydney airport and everything else that was going in. And I was living in Southwest Sydney, and I saw all of this huge development. There was a lot of vacant land. I like to say that. There was a lot of vacant land there. And still those areas seeing most growth in the last, or pretty much close to most growth in the last decade. I bought a piece of land there and I'm 800% now on it, essentially. And I'm thinking, okay, I was making then, I was seeing growth, and I'm, okay, why are these buyers agents not looking at these areas? Why are they looking elsewhere, and why are they thinking that these areas are not good enough, So I wanted to create something where there's centralized information, where people can access. Back then, there was some competitors out there, but essentially one thing led to another. That's how we got created. And Alex, my co-founder, he's a software architect. Used to work for the Big Four bank in like senior role, and I was lucky to meet him. And that's how we started essentially.
Have you tracked your performance, like even before HTAG, with like your locations?
Yeah, I have. I was buying back then mostly in Southwest, because when you start off, you sort of buy next door kind of thing, And I was lucky to actually make all the right moves. It was just luck. It wasn't, I did the analysis and all of that, So had a couple of in Gregory Hills, in Campbelltown as well. And that was about 15 years ago, and did very well with that. When it comes to HTAG, you can't essentially hide because let's say if you do an analysis, and I always stay away from when people ask me, give me the area, give me the best area to invest into. A lot of people hear me say, what is your brief? What is your investment time horizon, risk profile, and all of these other things, because I hate pumping out areas, because I always say a hotspot for me is not a hotspot for you. If I have 500K to spend and you're telling me about an area that's 800K, it's no use to me. You know what I mean? So,
very good point.
And in saying that, you can't essentially hide when you do an analysis for a particular brief. And let's say you shortlist 10 suburbs and people go buying those 10 suburbs, and then years later, we've been operating for 6 years. So it's sufficient time for people to come back and say, oh, Matt, that wasn't correct. But I don't do the analysis. I just show them how to superimpose data. And essentially, there's a feedback loop. When people come back and say, property investing is supply and demand. I always give the analogy of cupcakes. If you're baking cupcakes and you've got an amazing cupcake, there's one and 10 people want to buy it, you're going to raise the prices. The same with property, So there's economics there as a proxy that sort of allowed me to understand which metrics matter more than others. But then as people were making investments under certain methodologies and then coming back and telling me about growth, this is when we started revising the methodology and improving it, et cetera, and that's how we came to this point. But we haven't had, I guess, people come to us and say, I made a wrong call. They do the analysis, but you can't hide, essentially you can't hide. Sooner or later, somebody will come back or would come back and say, you gave me the wrong information,
So out of these, you said, and congrats on that. It's 6 years of building this. And then obviously you've had like your most important data points, and they've been revised when people have come back to you with feedback, right? This feedback loop only helps you create a better product for your clients. Do you have like what are the top, do you have like a top few that are the key metrics that most people use and look at that help them make their investment decisions based on their investment criteria? And if so, what are they and how did they get revised down? I know we're going to be jumping over like questions and overlapping things, but yeah.
Yeah, no, that's fine. So it's a good question. I mean, there's no particular set of metrics. I mean, we've got 100 metrics on the platform, and all of these metrics have a different time aspect associated with them. So there are short-term metrics, there are short-term, mid-term metrics, and then there are long-term metrics. And you need to layer those metrics in a particular way depending on your brief. So let's say hypothetically a buyer comes to you and says, I want to invest long-term, i.e. plus 10 years, but I want to extract equity in the next 2 to 3. So it's not only relying on compounding, you need to also focus on this equity extraction process, which means that you also have to look at the short-term metrics. So I can't say which metrics are the most important. There are some metrics that are important for a particular time frame more than others. Now, let's talk about short-term. If you're investing short-term, trend is your friend because trend equals direction. Property is a liquid asset, which means that it exchanges hands, less than, for example, when people buy and sell crypto and shares. And this inadvertently means that when you establish a trend for a particular metric, it is virtually impossible for that trend to shift from a month to month. So if you have a nosediving trend on a days on market, and let's say, today's days on market or average days on market is 30 days, in the next month, if you get 150, you're still not changing the trend. That's potentially an outlier in the data set. So the more trend you have, the more you can actually discern what's going to happen in the future. So, for example, currently on our platform, the short to mid-term metrics will be all of our supply and demand metrics. So you have stock on market, inventory, building approval ratios, and hold periods, which will be the supply side. And then you have the demand side, which will be days on market, vacancy rates, buy and search indexes, and clearance rates, depending on the market that you're looking at, So if you have trends for those, and those trends are, let's say, 4 to 5 years long, you can sort of discern. Usually trends shift, coming back to the analogy that trends don't shift regularly. So, for example, and Adelaide is a perfect example. I was just doing a live session last night where you see, some of the areas in Adelaide that still have a nosediving trend, but you see in the last 6 months, the days on market trend is much higher than the actual overall established long-term trend, which is indicating the short-term trend is actually sort of tilting the long-term trend up. And it will take about a year and a half for the entire trend to shift,
Right.
So if you have, for example, a nosediving overall trend as well as a nosediving short-term trend in these metrics, you can infer that within the next 3 years, the supply is going to be tight or demand is going to be increased, So this is the short to mid-term. Once you establish that, then you move on to the long-term indicators. And the long-term indicators, we have some innovative metrics that are on our platform, which we introduced recently. For example, how long a suburb is spent in the negative growth zone, because you can sort of discern market fundamentals from how long an area has actually returned negatively for a customer, renter to owner ratio, ERSAT, socioeconomics, industry centralization, and then all of the risk items such as bushfire exposure, flooding exposure, all of those other stuff you need to layer on top in order to determine market stability or potential for, I guess, surprises,
Yeah, there's a lot to it. I've gone through the what you've developed with the Telegram mentorship program, and I guess I've never seen it is so complex, but you've simplified it down for even for me to understand. So well done on that front. But yeah, I guess Jaryd, it depends what you want to put your time and energy into, right? This is it's a skill set in its own, and I think if people are interested in the data and really finding it, just jump on the HTAG website. We'll put a link in the description below as well. There's so much to it, and what I deal with clients too is because Matt's got 100 different metrics, and then you're also analyzing just the current the values, and then laying over the trend analysis as well. There's so much to it, and what I see people do is they get lost in certain metrics, and I think that's just the benefit of working with a professional as well, as you're fast tracking that process as well.
The guidance needs to be there. I mean, the penny needs to drop. I mean, the thing is, I haven't got any extraordinary qualities about me. It is just the fact that I've been looking at it for a long time, and I've seen sort of the results and essentially economics as well, I mean, I don't know what's going to happen tomorrow, yet alone in the next 10 years, but I want to increase the probability of a particular outcome, So for example, every data point is a representation of behavior. Let's use an example. High renter to owner ratio. What is high renter to owner ratio? When you really think about it, if macroeconomic conditions change to let's say, to impact investors in the sense that, let's say, rising interest rates, it becomes harder for investors to actually hold on to their assets, which increases the probability of them disposing it to the market, which potentially can increase the supply and dampen price growth in the future. So see how you construct a narrative about a data point, and that's a correct narrative. So when you have a high renter to owner ratio, you have to be careful because potentially it could impact supply in the future. And if you're holding it for 10 years, you are bound to go through one rate increase, So do you want to expose yourself to that kind of risk? And then you triangulate, you add other items. For example, let's say, you have a typical value that is 850K that you want to invest in, and yet the socioeconomics is extremely low. And then if you look at the data set, you rarely see a suburb with $1.2 or $1.3 million typical value that has an URSAD of 1 out of 10. It needs steam to actually get to a certain level. And you don't want to invest in an area that already creates a bottleneck or a friction point when it comes to the socioeconomics. So it is just triangulation and layering, increasing the probability. Do I know that it will happen in the future? I don't. But if the more I include, the more I think about it, and the more I provide a rationale about each metric and explain it to the customer, the higher the probability that something will happen.
Yeah, there's so much in that. Like, you hit on a good point too, and this is one of the key questions I'm interested in, and is with the obviously advancement of data, right? Like, property has always been, buy and hold, long-term mindset because of the entry and exit costs involved. What always griped me is that people would then look at short-term data to make their decisions, but like you've got to factor in that big picture. But now what I'm seeing through obviously your information as well is like property can be like a more medium-term traded asset if done right. And if you want to take on that, level of research if you're really interested, because everyone says you can't time the market, but there is a lot more information to paint that picture better now, right?
Absolutely, and it's an interesting observation. I do think that the industry is shifting in a sense that, and I'll tell you why I think that. So we have an issue currently with affordability. I think affordability has the price of property and the wage growth has the highest gap or the biggest gap since 2004, which means that affordability becomes one of these macro narratives that needs to be satisfied because in order to get a compounding growth or a compounding of demand between owner-occupier and investor demand, which sort of leads to above average returns, i.e. plus 10%, which is why an area becomes a hotspot. If you really, you guys will know better than me in the sense that buyer's agents, when you come to a market that's a hotspot, at one point, first it begins with owner-occupier demand, then it causes a positive feedback loop, which is referred to as reflexivity. And then that positive feedback loop incites more growth when investors come to the market. And at some point, you get owner-occupiers and investors competing for the same property. And, this is where you see above average returns, 10%. And then the market becomes oversaturated with investors, such as, the Perths of the world currently. And then it starts dropping off. Now, I sort of going in a roundabout way to explain. Because the affordability is becoming a crucial metric to make a decision, you are fronted with this notion of steam. How much steam is left in a particular market? Because if the market is affordable now and you get this compounding effect of both demands, if supply is restricted, you'll get above average growth, 10, 15, 20%. The affordability or the area is going to go into the unaffordable range and it's going to hit a friction point. So how much steam is actually left within that market? And do I want to remain in that market when the steam is lost, when there's a friction point? And then it comes back to a pen and paper exercise in a sense that, okay, selling an acquisition cost, put it down, see how much is left. And if you're timing the market correctly, i.e., and this is why, the warm spot methodology that we teach as well in the mastermind, if you're timing the market correctly, you can essentially enter the market before it becomes rampant. And hotspot lasts anywhere between 1 to 4 years, even 5 sometimes. Let's say, you have some areas in Townsville have returned in the last 5 years above 10%. I think Mount Louisa, Kerwins of the world, etc. So I classify a hotspot anywhere above 10%. This is an arbitrary figure. It could be 15, below 10. It wouldn't be a hotspot because I know that corresponds to, you still can find real estate within an area if it's returning less than 10% in the last year. So coming back to the explanation, sometimes it's actually better to enter a market, maximize the full extent of the hotspot, and then sort of exit if sales and acquisition costs permit.
Right.
You know, as opposed to stay in the market and then sort of grind it out for another 5 or 6 or 7 years until it returns back again.
Yeah, it returns back to like a cycle where it can start to see the growth rate increase in that area. And so you mentioned like years, hotspot being 1 to 4 years, maybe 5. Is that an average? Like, and just because, you know, people listening are like, oh, maybe I could, you know, buy something, hold it for 5 years. I don't need to hold it for 10 years anymore. That's maybe what listeners are thinking. And they're like, well, what's the average? Obviously, it's dependent on each location and how much steam is left. But is that an average 4 to 5 years?
Looking at the data set, I would, you know, the average would be about 3, which is why I say 1 to 5, you know, and again, when I look at the data set, I look at growth patterns across different time frames. I see, for example, in some Townsville areas that, you know, an area has returned 80% in 5 years, which means it's been a hotspot for 5 years, essentially. So the thing regarding that analogy, like I don't want people to come to a conclusion and say, that's it, you know, I'm investing for 5 years. You have areas that have, you know, good long-term potential and stability, which means that when they revert back to the mean, their mean is around 3 to 5% anyway, which is essentially Australian average. So you're still getting that effect of compounding. Where it becomes a bit dangerous and when you can shorten the investment time horizons is that when you see an area that has been not returning at all for, let's say, 2.5 decades, and then it gets a huge pump. My question to an investor would be, what do you think will happen after that pump? Think of an elastic band. Think of an elastic band, you know what I mean? So if, for example, I go to Coles and in 2000s when I moved to Australia, it used to take me $50 to fill up a shopping trolley. Now it takes me $300. So it's already altering my behavior and my purchasing patterns. Imagine how that works in the context of purchasing a property. So let's say you have an area that was not returning at all for 2.5 decades, suddenly sees a pump, dramatic increase in unaffordability, which is going to impact owner-occupier activity. They're going to drop off to the market, and then the nosedive could be as severe as the pump. And in that instance, where there's more long-term risk inherent within a particular area, you should potentially consider shorter time frames. But overall, compounding, what is it? The eighth wonder of the world. Is that what they say? So compounding is good in a sense that holding an asset, I always go by my personal preference is never sell an asset. That's what I go by, you know. Now, you know, it can be altered. And now, because the market is changing, I'm enticed in some instances to enter short-term and exit, you know. But, yeah, I mean, I don't want the listeners to think, that's it, I'm investing for 5 years. It all depends on the stability and the potential of the area to keep compounding at a lower rate after the pump. But if there's increased probability that an area will go into the negative growth zone, then, you know, it's better to exit because the asset becomes a liability thereafter, you know.
Yeah, it's basically a question of assessing opportunity costs along the journey with your different assets, right? Of like, okay, I've got this one in this location and it's just received, you know, 2 great years of 15% growth. And then you might see the year after it's sort of slowing down a little bit. Oh, well, what's, you know, how much equity do I have in that? And after debts and all that sort of stuff, where, like, is there another location that would provide me a better ROI after exit costs and entry costs for a new asset? Right.
No, exactly. Absolutely. I mean, every area has different levels of volatility. You have areas, for example, such as Taylor Hills of the world, which is in Victoria. When you look at the typical price curve, it's actually a straight line up. There's no volatility to the upside and to the downside. It's very stable and it's going up. Now, I'm not going to discuss the fact about what's going to happen in the future and whether it's going to go that way, but there's a higher probability that it will continue because of its past behavior in three decades, which means that its volatility is not high. It's a stable market, you know. Now, you have areas that have extreme volatility where you see, you know, typical price taking a nosedive and then pumping up and then coming down. The growth rate cycle is all over the place. Well, I can discern from that, there's more danger than if it pumps up, it potentially will also revert back to its old ways and evaporate my previous growth, which is why, you then assess the opportunity cost that you mentioned.
Yeah, and this seems like it's a very different approach to property investing than decades and decades and decades ago. And would you say that's just like merely due to more advancement in data at the moment, like where, everyone used to say, look, you just hold on forever, right? Or, 10 years, it's going to double every 10 years. That's a very average thing to say. But now we have more, sophisticated data. Do you think that is becoming more prevalent for property investors that are seeing that, okay, how do we assess?
That's an interesting question. You know what? I think there's an implicit fear in the population about what's going to happen in the future that is much bigger than it was before. Now, if my dad was potentially listening to this, he would say that, I don't know what I'm talking about, because every generation has its own fears, But I have a feeling that there's this, it's weird. It's a good question. I have a feeling people just want to get more faster. I think that's one aspect. There's a psychological aspect there. I think another aspect is, the quick wins, and I don't know whether that's, the problem of crypto and the fact that we've been just, just get as much as you can, as soon as you can. Then the other aspect or the other side of the coin would be, as you say, I think property, as Sam has observed as well, it's like a tradable asset, or is becoming like a tradable asset. And it could be because of that psychological aspect, but also because, as you said, the advancement of the way, information is articulated, I think that, looking at charts, superimposing charts, drawing lines across charts, that's an equity scenario, That's what people do in equities when they trade equities. Now, you're approaching property because essentially equities are more advanced in terms of timing, exiting, etc. And when you're timing and exiting property, you have to approach it in the same way, in the sense that, okay, what is going to happen in the short term, mid-term, and long term? We're just lucky that property is more illiquid in the sense that you're provided with more opportunity to time it. But I think it's an amalgam of many different themes here, which is why people are, approaching it in a bit of a different way than they did before.
Yeah, I've got a few theories on this one as well. It's like there's, you hit, bang on. Everyone's got that short-term mindset. They want that dopamine hit, and that's coming greater and greater in the younger generations. The other thing I'm seeing too is the middle-class wealth gap reducing over the last 50 years. So you're seeing the rich getting rich and the poor getting poorer, and people are actually looking to, I guess, maintain their net level of wealth. And when you factor in inflation, the way it's gone as well, wages have not increased as much as assets. So people are, from what I'm seeing, are trying to make up that difference by taking, well, I know my wage isn't going to increase because I'm PAYG, and I don't want to take on the risk of developing a business and a company. Where can I get that alpha to stay in that, I guess, wealth level? And that's where I'm sort of seeing people are leaning more and more to assets like property, but also the, I guess, people as well, they're becoming like in your markets, like affordability is a massive point that Matt hits on in his data. And we do, that's like one of the key indicators that we start the filtration system with. People are, still aspiring for property and they understand it, but they can't afford it. So that rent vesting mindset it appears becoming more prevalent in the property side of things as well.
Yeah, absolutely. I mean, the briefs that you get, Sam, for example, I would argue that 9 out of 10 briefs are now below 550K value, simply because of that affordability aspect, and it's like, you're right. I mean, I think our purchasing power, the Coles example, our purchasing power has been eroded dramatically. At the same time, the social media has sort of instilled in us this desire to actually become free of the chains of regular employment and all of that. You're seeing all of these influencers and all of that. So, okay, why not me, in a sense? So yeah, there's a lot of different angles here, but I do think that, and which is why it's one of the reasons why, it should be inverse. Instead of actually putting in more time to understand things and actually make an accurate decision and actually make that money short term and long term, people are really rushing into and following, personalities, and just, following, the group essentially, wherever they go, because they don't have the time to actually sit down. I have a lot of people tell me, oh, Matt, like the comparison sheet takes me 5 hours to do. And then I'm, okay, so it takes you 5 hours to do something very precise that you're going to spend $500,000 on. Why is that a problem? Like, and not only that, but before, I'm asking him, how did you do it before? How long did it take you? And I know we've done surveys when we started the business about 2 years in. It used to take buyer's agents an average week to week and a half to find the right location. How they did it, I'm not sure, but that's essentially the average, So, but still sitting down, people are averse to sitting down and actually spending 5 hours on something. I know it's mine. Don't get me wrong. I don't like data. I'm more of a qualitative person, which is a bit of ironic. But, you don't want to invest the time. And I have so many members that, I try to, let's go on a one-on-one, I try to push them. Let's do this together, let's do it together. Do it once and you'll get it. And then you can just replicate it. No, I've got no time, but yet you want the returns. It's just weird. I just don't understand it. You know what I mean? Sometimes
this is the mentality of people that want everything for nothing.
Yeah.
In this day and age. But yeah, like it's what a gift, right? To be able to go from a week and a half of analysis to work out what your investment's going to be to 5 hours. That's insanely amazing.
Well, exactly. What's exactly? That's what I think.
Mate, it's not good enough, mate. Just pull your finger out. And
No. By the way, I'm just actually, before we got online, I was actually working on developing an AI thing, which is going to take minutes now. But the problem this is the problem. If you build something that takes minutes to do, you don't get a learning experience.
Also, I agree. Also, you skip out on that learning experience is so vital.
Absolutely.
It's almost more important than the asset that you end up purchasing, because you can use that education for further purchases as well.
And explaining it to your client. Like, let's say people ask me, Matt, where should I invest? I go, if I tell you where to invest, how are you going to explain that to your client? How are you going to tell your client that this suburb is a good location? I just don't understand the question. Like, I'm baffled by the question because go. Sorry.
Yeah. I just think, so people, just
I got a bit excited there.
No, I agree with you. A buyer's agent is going to use your tool and they're like, okay, just buy this location. And then you have a sophisticated investor that says why. You look like you have no idea what you're doing. Also, at the same time, a buyer's agent that goes, say, for example, somebody's using your software, which is a buyer's agent, and their goal is to buy the best properties for all their clients and make, $10 million a year through their buyer's agency service by using your product. And you go, yep, you can use my product and it's going to cost you, whatever, $500 a month or whatever it is.
No, calm down, Jaryd. I want it cheaper, mate.
Yeah, but this is the thing, right? People, and then say if you made your service, and it was $500 a month, and it took people an hour a month to, work out all of their briefs and have all of these locations and properties for each of their clients. They're not going to value it as much as if it took them longer to do and cost them more money to do as well, right? They just don't value it enough because there's not that level of accountability there.
There's so many elements there. Like I've seen, for example, this is the issue with aggregated scores. So if you provide an aggregated score, like, this suburb has a score of 75 for capital growth, the other one has a 65, go with 75. Okay, first, what's under the hood? How are you going to explain it? Now, we got scores on our own platform, but I always tell people you need to reconstruct the score. You need to understand why. So that's the first thing. The second thing is that when people get annoyed with, and I've seen this psychological transition as a business owner, when people get annoyed with the fact that they have to put in some work, if they click on the button, they'll be annoyed because they don't know how they got there. They will say, okay, hold on, I'll get phone calls and say, Matt, I know, Mount Louisa is number one, but, like how? Why? And it will be the same person. That same person would actually ask me, "Oh, Matt, it's taking me 5 hours to do something." And when I make it automated, first they wouldn't learn, and then they would be upset because it's too automated. So it's like, how do you actually, the issue is, I think, and I'm not trying to bag anyone. What I'm trying to say is that I think the learning occurs when the effort is made. And now there's a thin line between making it extremely difficult and not user friendly, and still educational. You know what I mean? I know there's a thin line you need to tread there. I do get it. But anything, you do, you need to invest the time. And if you do, your business is going to grow substantially because you're going to start speaking in a type of a lingo that's understood and reflects competence. You're not going to be questioned. Do you know how many members we have that are calling me and telling me, "Matt, since I've done the comparison and I spoke to my client, they haven't questioned my fee. They haven't bat an eyelid about my fee." Because they see a comparison, you take them through it, you explain, and they're like, "Oh, okay." Even if they don't understand it, they saw an enormous amount of effort invested into it to come to a particular conclusion.
Yeah, this is the scary thing, right? And this is what Sam and I are all about. Is like, it's not just in this industry, but this industry is rife with it, is that you have the blind leading the blind. Like, you've created such a good tool that you can have somebody come and use it and just say, "All right, client, buy this." And you've got all these buyer's agents that are calling you because they don't understand what you're even presenting. Whereas Sam, he's been in the space as a valuer for like 15, I don't know how long ago you studied, Sam, but like 15 years ago or so. Like, don't want to age you, even though you're younger than me.
Cheers, man.
But you've got these people that have just become a buyer's agent 6 months ago. They've done a course, paid 10 grand for the course or whatever it is, and now they're a fully fledged buyer's agent. They've got the access to the data, and it's like easy for them to make money. But how long are they actually going to last when they don't know what they're doing and how to analyze the data versus someone like Sam?
Yeah, and they'll follow. See, this is the thing. I've done a masterclass recently on that, entering a hotspot at a particular time, coming back to the argument of timing. I mean, I have nothing, and I keep on talking about Perth, and I start a witch hunt essentially when I mention that. But, I have nothing against a particular area, but I do have something against the person who comes online and says, Bunbury is a great investment location, and he doesn't tell you for how long, for who, etc., etc. So if you go into particular locations, you just follow what people say, and you enter at the top, you're going to completely destroy your buyer's agents. It's not going to return in the next 3 years, and you're going to be judged by the initial return. So they're not going to come back. You're not going to build a portfolio for them. Plus, you're going to refer any of their friends to you. So it's essential to know and to actually do the analysis yourself instead to follow someone. And that's the main thing that I'm passionate about. I sort of hold my tongue mostly online because I don't want to. Because if I start, I can't stop then,
We've got you. We're just a little bit of play here going on, Matt. We're going to get to the the real juice soon.
Yeah, but no, absolutely, man. Absolutely. I think we're on the same page.
And we'll just pause this one here. This is part one, finishing up, because it was such as Jaryd says, a beast of an episode, and as you can see, it's quite data heavy. We're going to break this up into part two, where we talk about just buyers agents and investors using this data, and what's that creating in the industry, and what to expect moving forward in the property investment landscape, and even is there going to be a need for buyers agents in the future? Because with all this advancement of technology, it's constantly changing, and to be a good investor, I believe that you need to grow with it. So I hope you enjoy part two.